You've tried a single backtesting platform for both U.S. stocks and crypto. The equity factors look great, but in crypto the same momentum signals decay after a week. That's not a bug, it's a structural reality. Cross-sectional factor mining demands separate, industrial-grade tool chains. Equities trade in regular sessions with deep short-selling capabilities, while crypto runs 24/7 with perpetual funding rates, limited short access, and extreme tail risk. A momentum factor that ranks stocks by 12-month returns often fails on altcoins because cross-sectional momentum in crypto is short-lived and easily erased by funding costs. Consequently, the statistical properties diverge. Equities allow slower decay and broad factor universes. Crypto demands daily rebalancing, strict cost modeling, and neutralization against Bitcoin's beta. This mismatch means a single code base, no matter how flexible, will hide these structural breaks. The practical fix is to split the research stream into two dedicated pipelines, each with tools built for that market's microstructure from the ground up. For U.S. equities, 3 open-source libraries form the backbone of institutional factor research. Qlib, developed by Microsoft, is an AI-first quantitative platform with built-in factor libraries, Alpha 158, Alpha 360, and native support for cross-sectional operators like rank and z-score. Zipline Reloaded, the descendant of Quantopian's engine, delivers the pipeline API, allowing factor computation across the entire stock universe while rigorously blocking look-ahead bias. Alphalens Reloaded then takes the generated factors and subjects them to a full diagnostic, quantile returns, information coefficient, IC, analysis, sector neutrality, and turnover estimation. Together they create a clean loop. Qlib or Zipline mines the factor, Alphalens judges it. No framework alone provides this complete feedback loop with built-in protection against data snooping. A typical cross-sectional signal starts with a stock-specific time series calculation and then ranks the result across all stocks at the same time point. Using Qlib's expression engine, we first compute the 20-day historical volatility of daily returns, a backward-looking, single-asset metric. Then we rank every stock in the universe by that volatility value, converting a time series number into a cross-sectional percentile. Finally, we map the percentile into a trading signal. Stocks with volatility above the 80th percentile get a short signal, those below the 20th get a long signal, and the middle band stays flat. This two-step transformation, time series, then cross-section, is the standard pattern for equity factor mining. The validation path is straightforward. Observe the resulting signal's information coefficient over a rolling sample, estimate the long-short portfolio's Sharpe ratio net of realistic costs, and check whether the alpha decays when out-of-sample data arrives. While Qlib and Zipline excel in equity-only research, 2 other engines extend the toolkit. Backtrader's 2026 cross-sectional mode processes multiple assets simultaneously at each time step, giving you full control over portfolio weighting and dynamic rebalancing. Its cross-sectional ranking strategy, rank by momentum, pick top N, equally weight, is a perfect teaching prototype for the mechanism. For enterprise-grade needs, Lean, the engine behind QuantConnect, supports equities, options, futures, forex, CFDs, and thousands of crypto pairs. With a 180 contributor codebase and a cloud backtest that finishes a 10-year U.S. equity run in over 30 seconds, it is the closest open-source path to a production pipeline. The trade-off, Backtrader is easier to install and customize, Lean demands more setup but delivers multi-asset, high-fidelity cost modeling. WorldQuant's Alpha Factory approach, generating thousands of candidate signals and screening them through a strict backtest, is the gold standard of systematic equity investing. OpenAlpha replicates the proprietary WebSim API, so individuals can run the same alpha expression to backtest flow in Python and C++. Combine it with Qlib's pre-built factor library and tsfresh's automatic time series feature extraction, and you have an open-source reproduction of a mini alpha factory. Qlib provides the base factors, tsfresh explodes them into hundreds of derived features, OpenAlpha scores and backtests each one. This pipeline can produce thousands of candidate factors, but the real challenge lies in the next step, discarding the 99% that are statistical noise. That's why the factory mode must be paired with the strict validation discipline we discuss later. Crypto markets operate under a fundamentally different regime. Trading never stops, short positions are expensive or impossible for many altcoins, and the entire altcoin universe is strongly tethered to Bitcoin's price. Cross-sectional momentum, a robust factor in equities, often fails in crypto because a Bitcoin-led rally pushes the whole market up, leaving the ranking meaningless. Moreover, taker fees, slippage, and funding rates compound rapidly. A 0.1% per turn cost in equities becomes a 0.4% to 0.6% round-trip drain in crypto. Any factor pipeline must neutralize Bitcoin exposure, model costs daily, and detect periods when all coins become highly correlated, moments when cross-sectional dispersion collapses. Off-the-shelf equity tools lack these safeguards. The next slide introduces the dedicated crypto libraries that handle them. Two open-source projects stand out for rigorous cross-sectional crypto research. Phandas is a lightweight Python library that provides 60+ time series and cross-sectional operators, factor neutralization via vector projection and regression, and a dollar-neutral backtester optimized for perpetual futures. It outputs professional metrics, Sharp, Sortino, Calmar, VAR, PSR, and integrates with AI agents through MCP. The second project, SecQuant, is less a library and more a research manifesto. It dynamically selects a top 30 perpetual contract universe by monthly volume to avoid survivorship bias, enforces a locked holdout with git-tagged parameter freeze, applies Benjamini Hochberg false discovery rate control, and caps leverage at 1x per side. Together they provide the computational engine and the statistical discipline that crypto factor mining desperately needs. The most common mistake in crypto factor research is treating any altcoin signal as alpha when it simply captures Bitcoin's movement. Phandas addresses this by removing the Bitcoin factor's influence through orthogonal projection. In practice, you rank the raw factor, say, 20-day momentum, and rank Bitcoin's inverse dollar volume as a proxy for market activity. Then you project the momentum rank onto the volume rank and subtract that projection, leaving a residual signal that is uncorrelated with the noise proxy. This single step, often just one line of code, prevents the backtest from falsely attributing Bitcoin-driven returns to the candidate factor. After running the neutralized signal through the backtester, the proper validation is to split the data into locked holdout periods, observe the out-of-sample information coefficient, and check that the factor's alpha does not vanish when Bitcoin's trend changes. When you need to explore thousands of factor ideas, manual feature engineering becomes a bottleneck. tsfresh automatically extracts over 700 time series features, statistical moments, frequency domain coefficients, trend patterns, and rolling autocorrelations, from basic price and volume data. One documented case turned 11 raw time series into 8,613 derived factors, which were then fed into a support vector machine for market timing. tslearn, built on the scikit-learn API, complements this by offering k-means, shapelet, and time series specific algorithms that can uncover nonlinear factor structures. However, auto-generation comes with an enormous overfitting risk. These features are metadata, not predictive signals by default. Every candidate must pass a strict walk-forward filter, and the factor count must be corrected for multiple testing, otherwise the sheer volume of comparisons will produce a seemingly significant factor by chance alone. When you test 1,000 factors, by chance alone you expect 50 to appear significant at the 5% level even if they are pure noise. The Benjamini Hochberg procedure controls the false discovery rate, the expected proportion of false positives among rejected hypotheses. It works by ranking all p-values from smallest to largest, then finding the largest index k where k, is less than or equal to k divided by total number of tests, multiplied by the chosen false discovery rate, typically 10%. All hypotheses with ranks up to that k are rejected. Incorporating this after every factor suite prevents the Garden of Forking Paths problem, where many plausible signals are just artifacts of multiple comparisons. A practical validation is to simulate a null data set, run the same factor mining process, and confirm that the corrected procedure rejects no more than the specified FDR. There is no single open-source silver bullet for cross-sectional factor mining. For U.S. equities, the Qlib, Zipline, Alphalens triad, possibly extended by Backtrader or Lean, delivers a professional pipeline from raw data to validated alpha. For crypto, Phandas gives the computational muscle while SecQuant teaches the statistical discipline that keeps you solvent. Auto-feature generators like tsfresh can expand your universe, but only if paired with walk-forward validation and multiple testing correction. No framework will save you from overfitting. That discipline must be wired into your process. Start with the right combination for your asset class, and let the tools serve the hypothesis, not the other way around. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.